Greetings, Dr. Jeffrey Scott here. This is my weekend market update for New Year's Eve, 12/31/2023, and I titled it Santa Limps into the Weekend Near All-Time Highs. My email address is hgsidoc@gmail.com. If you're new to the channel, please hit the subscribe button, hit the alarm. You'll know when I post these. I don't keep an active mail list. I don't send this out to more than just a handful of close friends. Um, so most people just find it on YouTube. So again, thanks for being here, and let's take a look at the markets. And as we get started, I will like to wish everybody a happy new year, happy, safe, and healthy new year. As always, this is for educational purposes only. Anything I talk about, any stocks I mention, any trades I mention should be considered hypothetical and taken in the spirit of education and not investment advice. I am a doctor, not a broker. I have plenty of licenses, but none of them would give me the legal rights to tell you and advise you of how to manage your own money. I'm independent. I have my tools that I'm showing you today, excuse me, on a number of different platforms, but I'm independent of the platforms and I pay for the tools that I use. And trading involves risk, and you're solely responsible for any investment decisions that you make. So a week from Monday, January 15th, will be the Wealth 365 event. Still not sure when I'm speaking. They gave me a time, but I had a conflict. I will put the link to register in the remarks section on YouTube. Would really appreciate if you registered under my name. Why? Because I don't have a mailing list. I get requests that I do promote this, which I'm happy to do, but this is the only promotion that I do, and they actually keep track, and your future attendance sometimes is dependent about how many people will sign up. Major markets tell the story as always. So the first thing is quieter week this week. Not surprising. It's the week between Christmas and New Year's. Volume is typically low. And you could see also a little error here that my look back's 5 days. So this actually takes Christmas Eve in as well. But over those 5 days, the only thing that that was down over the 5 days is the Russell was actually down a teeny bit. But this was after the Russell had been up significantly. You could see over the 5 days the gold was up a bit. Biotech continues to do well. But then you could also see what happened on Friday, that for the most part, the markets actually turned down. Again, probably not a lot to fret here. It was a low volume week, and we'll see what happens over the next couple of weeks with the market. Sectors down on the week were discretionary and energy. Now these are all the S&P 500. We're going to talk about the S&P 1500. And one of the things I love about Sagar's tools is you can really get a sense of what's going on in the market intraday by looking at how many sectors are up, industries are up, stocks are up. And often the indices may be holding on when you see significant weakness underneath, and that at least alerts me to where the market's going. And you could also get it the other way around, where the indices are down, but you start to see the underneath get stronger. So if you look at the last 2 days, so Thursday and Friday, you could see 82% of the sectors were down, 85% of the industries were down, and 76% of the stocks were down. Look at the last month where we came from. You could see the majority of stocks, industry groups, and all the sectors have been up over the last month. So is this just a couple little day change, a little dent in the armor of the bulls, or is something actually happening here? You can see in the S&P 1500, unlike the S&P 500, all the sectors were down. And 84% of the stocks here in the S&P 1500 are above the midline, their Bollinger Bands. So it's interesting, and we'll see if this foretells some weakness at the beginning of the year. This is another of Sagar's Q tools. This is called, excuse me, Q market breadth. And you can see here a number of things. If you look in yellow, stocks above the 50, they're as high as they've been, even with the weakness that we had on Thursday afternoon and Friday. So markets are certainly extended. You could look at the preponderance of stocks, the AD advances to decliners. Obviously, it took a drop on Friday. You can look at the up-down volume, decidedly took a drop on Thursday and Friday. And you can look at the new high, new low percentage, which is really, sorry about that, I've got my allergies are acting up, which really took a change because for so long we had a preponderance of new lows. But this rally off the October lows, this brilliant, strong year-end rally, has been accompanied by a lot of new highs. Down here, this green line is that 13-week new high, new low ratio. You can see it's still up in the clouds. So this market is still extended. You can see this was a Phoenix, which is a exuberant move to the downside, followed the next day by a Eureka, which sort of negated it. And this was the Wednesday a week ago. Over here, you can see these blue arrows. These are bangos, which is exuberance to the upside. And these often occur, as they did back here in July, before a market pullback. The skull and crossbones is the Hindenburg omen, which we don't have right now. And then down here you get the opportunity to look at breadth, thrust, exuberance by index, which ones are making the big moves. And I call out a week ago Wednesday as a day that we saw a big move to the downside. I call that a shot across the bow of the bulls. And notice that the sell-off on Thursday and Friday was much more muted with none of those red dots. So if you're bullish, that could be a positive sign. And then the Nick Drendel spreadsheet, which I keep up every day because it gives me a sense of what's working. And I apologize for my allergies today. What's working, what's not working in the market. And you could see, modest declines on the big guys. Small cap growth took it a little bit heavier on Friday. You could look at the one-day change. China led to the upside with staples, so that's probably the staples at least defensive. Over the 5 days, the big leader again continues to be biotech. And then the very important new high, new lows. Whether you look at 1, 3, 6, or 52 months, I don't look at all-time highs as being as important. As I showed you, decidedly bullish. Rates ease on the week, you could see in white the 10-year was down 0.9% on the week, and the 30-year was down 0.86. Although they were down, they were bouncing by the end of the week. These are weekly charts, not daily charts. Recession in our near future. I am in the camp that we will get a recession, and if I had to predict when, not that predictions mean anything, as I would predict something after the new or returning president inauguration in 2025. If you are in the we're going to have a recession camp, then you'll point to the first top two, which is the 10 minus 2, 10 minus 3 yield curve, and you'll point out that as this yield curve crosses the zero line, the inversion line, is when you see the gray bars. Okay, the gray bars. Those gray bars represent recession. So every time there's been an inversion going back to the 80s, you've ultimately seen a recession. So yeah, we probably will have a recession. You'll also find that as the yield curve steepens, heads up, you might see some weakness in markets. So that's something to watch. Now, Is it a chicken or an egg phenomenon? Why? Because if we're looking at, let me see if I can get the drawing tool without messing up. If the yield curve is the 10, it's not going to work. Let me try that one more. I don't want an arrow. Let's see now. If the yield curve, no, it's not. All right, I thought I would draw this and show you my thoughts about the yield curve. If the yield curve is the 10 over the 2, and when you have it inverted, it's because the yields on a 2-year are higher than the yields on a 10-year. And if you think about under normal times, the longer you put your money away, the more interest rates you get paid. This is why it's called an inversion. Now you can fix the inversion by the long rates going higher and keeping the short-term rates the same. That probably would not be great for the market. The other way you can fix the inversion is by the short-term rates coming down, and that's typically what I'd expect. Why would short-term rates come down and come down quickly? They'd come down quickly because the economy was in trouble. So right now the economy doesn't feel in trouble, and that's why I don't think we have a recession that's imminent. The other reason is simple. What happens in 2024? A presidential election. It's probably the second best of the 4-year presidential cycle. You've got everybody in the House coming up for election, plenty of senators coming up for election, and you're going to potentially have Biden versus Trump part 2. Nobody wins if the economy goes in the toilet. So I think you'd expect to see pressure on the Fed to lower, and you see some fiscal spending to prevent it. So they're going to kick the recession down the road. If you're in that we're not going to have a recession camp, I'll point out 2 things that say that's not imminent. This is the Fed Diffusion Index. It's sort of a gauge of economic industrial activity. And when you get below minus 20, as it recovers, you often see recessions. Well, we are no longer below minus 20. We got above the 0 line. So I put this as neutral. And if you look at credit tightness, we'll use the Bank of America U.S. High Yield Index Option Adjusted Spread. Typically at times of recessions, this will spike, and this is not spiking at all. So that's why I gave my comments about I don't see a recession coming. Breadth eases a little bit. A little bit. You can see the 13-week new high, new low. T2121 and the TC2000 came down. This is so predictable. When you get to the top, the markets will stumble, go sideways, or come down. Stocks above the 200, stocks above the 40 also pulled in a little bit. Big change in the market, and the reduced exuberance can be seen in this chart. December 29th, so Saturday, I ran my buckets. 84% of the stocks in the S&P 1500 were above the midline of their Bollinger Band. That's bullish. But like no stocks are above. Contrast that to the 14th, so 2 weeks earlier. 91% of the stocks were above the midline of their Bollinger Band, and over 50% were above their bands. This is a market on the lower right that's going to pull back. Could go sideways. Don't know how big of a pullback, so it's not a doom and gloom. And to the left is one that is not extended. No, I wouldn't expect a Hindenburg omen anytime soon, although as we get to all-time highs, which we are in the Dow and the NASDAQ, it's not impossible. What I want to point out is really for the first time in a long time, we've got no new lows on the NASDAQ. We haven't had very many new lows on the NYSE. Although notice that with the weakness the last couple of days, the number of new highs, 52-week highs, came down on both. Now, when I looked at the markets using my group performance analysis tool in HGSI, I could see that more than half of the different groups that I follow, these are predominantly bullish groups. Now, Trilogy Sells is a John Person sell signal, so that one was down, but that means it was up. Weekend bears, I expected to do poorly. It was down, so it's up. My trade station sells are down, but those are stocks that I would have shorted, so or I would have drawn shorts from. So I'd say that was a positive market week. And in this tool over here, using EdgeRater and basically slicing and dicing all the stocks in the market and looking at how they perform versus EPS, relative strength, or group rank, or ERG when I add them together, no pattern except for the most part was positive. Know your news and earnings. We do have some employment this week and the monthly employment report on Friday. We'll also get the minutes of the Fed meeting on Wednesday, and we're still in that point where everybody's assumed there's a pivot. Everybody's assumed that the cuts are next. Everybody's assuming more cuts than perhaps the Fed is telling us. So there still could be some market moving interpretation from those minutes. Earnings season starts. Is Bristol Myers Squibb, for example. And as I say in the lower right, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. So we closed with a 9-week winning streak, except on the Russell. Volume was low. All-time highs on the Dow and the NASDAQ. The S&P got within 3.6 S&P points, not spider points, S&P points. Interestingly, the 10-year rates remained unchanged on the year after going from 3.8 to 5.02 back to 3.88. Now, this was an interesting market. I played golf yesterday with my friend John Person, and we were talking about how good the market was. But it was different markets during different parts of the year. But certainly for me, the end of the year, the last quarter, was really where I saw most of my outperformance. But look what we went through. We went through sort of a failed COVID reopening in China. We had bank failures. We had a ouster of the Speaker of the House. We had 4 rate increases. We had a Mideast conflict and war. 30-year mortgages of 8%. Bitcoin led the markets. 10-year rates as high as 5%. 2/3 of the game from the Fab 7. And a protracted yield curve did not lead to a recession. So a very positive year in the market, especially when you compare it to 2022. We've taken out the 2021-22 highs in the Dow and the NASDAQ. We're right there on the spiders. So it was a great year. Who would have thought that in July? And we'll take a look at some of our market timing models and see if they supported that. Now, we enter the new year after 2-day reversal at or near all-time highs, less extended, earnings season's coming, lots of news going to hit us in the first couple of weeks. So it'll be an interesting year as we see the ebb and flow of rate cuts and economic data, as well as what's likely to be a very contested presidential election. So I ask you again, help me out. I've been doing these things for a long time. I don't charge. I'm not stopping. Register for the Wealth 365 event using my link below or in the remarks section of YouTube. And then tell me how I can improve these. Yes, get rid of my sinuses. My wife tells me that too. That ain't likely to happen anytime soon. You can either email me or put a comment on YouTube. What can I do differently? Is it platforms? Is it length? Is it content? Tell me how I can be better. Again, hit the subscribe button. Check out my daily videos, which are shorter at stocksanddocs.com. And then you'll be seeing some announcements soon about our Orange County meeting, which will be coming up in June. And then before I get into the charts, again, the Wealth 365 event coming up on the 15th. Okay, we're going to do most of the rest of all the rest using wealth charts. And let's talk first about my timing model. Let's look at my timing model in retrospect. My timing model includes 2 simple things, and that's why I call it my simple weekly market simple trading model. One is price has to be above the 30-period WMA, and 2, the weekly bongo has to turn green. If we look at 2023, we actually went green on the bongo, but really didn't have a clear buy signal, short-term buy signals until we got to March of 20, actually, let me get this right, March 27th of 2023. And then we had a pretty strong move up until losing the buy signal in September. And then the buy signal, and this is on the spider, came back in November and ran us into the end of the year. Similar findings if you look at the Qs. You would have gotten into the market in January. Actually, you closed here on the 17th, and you would have rode most of this wave of profits. You would have been out of the market for some sideways move and back in for the year end. Not so pretty on the Russell. And the Russell's interesting because I looked at this and I said, we went from one Darvas box to another. So let me get a shape. Let's do a rectangle. You could almost argue that somewhere in this box you could capture the movement of the Russell. And that's, all right, did I screw the pooch on that? Let me try that again. In this box you can capture the movement of the Russell in 2022 and 2023. And let's change this color to yellow. And then you can go back here and you could look at this market here, and you basically had a similar story where, gosh, for quite some time you had the Russell in also in a Darvas box. This was a false breakout that frankly flipped my model and trapped me and others in November of 21 to December or so 2021. And what we know is often when markets fail breakout, they go the other way. We went from one Darvas box to another Darvas box. Well, the good news is on the Russell, we have now broken out of the Darvas box. So the weakest here has been the Russell, although, boy, from the bottom of the box to where we are, it's had a massive move. And the diamonds have broken out, as have the others. But if you think about this market, it's probably no surprise that the Qs and the spiders really did well with our timing model for this year. So right now, we're in buy signals on all of the major markets. And yes, if we look at the long-term daily charts, again, spiders, Qs, diamonds, Russell, how much damage did we get this past week? A little bit on the Russell, but the Russell really had moved so far, really not much damage. So I don't think this rally is necessarily over. Could be, but the markets look like they're getting a very needed minor pullback. If we go into the major indices and we start with the 5-minute chart, Tuesday we opened up, traded higher on the session. Very strong day Tuesday. Wednesday was a sideways day. Thursday saw us gap up and then really sideways again. And then Friday hit. And Friday was a lot like Wednesday of the prior week. Now, interestingly, those indices were up Thursday, despite weaker underneath on the Q edge tool. And Friday we sold off. And then starting around lunchtime, we rallied a little bit into the close. If you look at where the week started on the opening and where we closed, we were up on the week. It was just a very modest move. In fact, if you look at the spider, you could see Actually, we were down on the week, because I was looking at 5 days, not the 4 days. Let's see. No, the weekly bar we were up. Yeah, we're up a little bit on the week on the spider. Here's a weekly bar. Yes, that's what I was looking for. Up 0.35%. So sort of a nothing week. No big surprise. Is this a topping bars? It's a low closed doji and John person speak, but it's got more of a bottoming tail than a topping tail. I think it's a pause to refresh, and I think we could certainly go higher. I hope so. Qs, similar pattern. Again, how is this much different than what you've seen here? Are we going to get a little bit of a flag and a further higher? Diamonds look even less ominous. Nice bottoming tail. The Russell still holding above this line here, and this line here goes back pretty far. This line goes back into the August 2022. So this is a pretty good support, I would hope. On the week, the VIX was down 8.79%, and on the week, the UUP was down 1.26%. But on the daily, just like I'm going to show you the 10-year, it bounced on Friday. When we look at commodities, dollar was a little stronger at the end of the week, so no surprise. We were down on gold a bit. Silver pulled back into the 50 and the 200, down a little bit more. Oil remains weak. Forget natural gas for now. And then the 10-year, as I said, it down on the week, but bounced into the end of the week, although not a very big move. So you still got the dollar and 10-year are favorable. Oil is favorable, and those have been the big tailwinds or headwinds based upon the time of the market. I think the market still has some opportunity to go higher. If we look at the broadening of the market, and we'll just look at the top two on the right. Equal weighted spider, when you're going up, is in dominance over the cap weighted. When you're heading down, the cap weighted. So you can see the equal weighted on the spiders and the equal weighted on the Qs are outperforming or performing as well as the cap weighted, and that's a big change over time. When I look at the S&P 500 sectors hourly, a lot of things turned down. Now remember, this is not absolute performance. This is performance versus the spider on a ratio chart. The things in the upper right are still biotech. Healthcare has started to come up on the short term. Discretionary weakened on Friday. A little bit of upturn on utilities and staples, probably defensive in nature. I don't see anything that's really standing out. Industrials have held up, as did financials and technology. But after a couple of weekdays, not surprised it doesn't look as attractive. I go into my dashboards and we'll start with the heat map at the S&P 500. Now, again, Friday was a down day, modestly. Just to review how down it was on the S&P. 0.29%, very modestly down. Despite that, look at all the red on this chart and some of the big cap tech. Now, it wasn't profit taking because T minus 2 or T plus 2, the last day to take profits would have been Wednesday. Maybe people were taking, the last day to, let me say this again. It wasn't loss harvesting because the last day to get losses harvested would have been Wednesday. It could have been some profit taking. And we'll come back to this later. If we look at Wealth Scanner, you're going to see this is weakened considerably compared to where it was on Monday when everything was above 800. We go down to the sixes. So pharma is where the strength is. Straight run up. Israel, Arc Genomic, Switzerland, momentum still strong. Healthcare has picked up. Fidelity Magellan, value dividends, autonomous technology, robotics, space exploration, and now we're dropping down quite a bit. So the point here is that there's some rotation occurring. And a lot of what we've seen with the markets pulling back probably is rotation more so than correction. And that's good. That's a great way to work off being overheated. Now, the way that I like to dice and slice the market is to use my CAT scanner. In the CAT scanner, I could put in any symbol list. And what I've done in the CAT scanner is I've looked, and I'll just give you a background. Over trading for 25 or 30 years, I found certain characteristics have associated with most of my biggest winners. The first thing is a lot of my biggest winners have either come out of a base, so they've been going sideways for some time, or have pulled back in an uptrend. Second thing is often they're in a squeeze. The Keltner channels on the outside and the Bollinger Band channels squeezing on the inside, building up sort of pressure. Don't know which way it's going to go, but that squeeze can push it further. And then I noticed that there were certain technical things that occurred as the stocks went higher. Momentum, breakouts, volume, and gaps. And then I also noticed that as something went further and further higher, and it got further away from its moving averages, that it would reverse. And when you applied math to that reversal, you could actually identify the point where it's likely to reverse because it's where it's reversed multiple times in the past. And that's the high jump. The other thing there, which we don't talk much about, is the EMS, which is an independent trading model. So if I run my biotech and pharma stock list through the CAT scanner, there are various things I can look at. Now, I still like pullbacks in an uptrend, but notice the list disappears. Why does the list disappear? Because after the run that we've had off the October bottom, there's not that many good pullbacks. If you have a pullback today, it's probably a big laggard. So Grifols, which is a specialty pharma, I think it's like a plasma play, nice uptrend, pullback in the 17, and then look at what happened on Friday. Big volume. Now, you got 4 dots here, which means it had a big gap. You only got 3 dots here because I take out the top dot, which is the gap, when I close in the lower part. But you had gap, volume, breakout, momentum. This is relative strength. I found that the comparative relative strength of an instrument versus the S&P 500, the relative strength takes off as a stock makes its big move. And this is volume versus a moving average on the OBV. What I don't like about this is that extension's at 100%. So I would be very careful with this. I don't like how it finished. Well, we're not seeing many pullbacks and uptrends. All right. So I could look and go, what about bear retracements? Now, I'm not expecting a lot of bear retracements because we're not in a downtrend. So none of them are there. And then I'm left with a couple of other scans. And I'm just going to pretty much today use my momentum up scan. And why would I do that? Because the momentum up scan doesn't care about pullbacks and trend. It just cares that I have momentum signals. So these are the biotech and pharma stocks that gave me a momentum signal. And ADTX, I don't know anything about it. It's clearly a beaten down stock and not the kind of thing that I go chasing. If you look at the right hand and you see these prices are very high, and now you see it's a $9 stock, $6 stock, whatever it is, this is kind of the picture of a lot of reverse splits. So I'm not interested in this company, so I'm going to skip it. But what it shows you is a pullback into the moving averages, a gap up on massive volume, relative strength in OBV, but I wouldn't play it. Grifols looks better, but I don't like how extended it is. And then I'm dropped down to one. I don't get that excited about ones. Now, I know that Insight looks very interesting here. This is a stock that's got drugs on the market, a really good management leadership team. And this is one where I think you took the baby out with the bathwater, and as biotech sold off, it took Insight with it. Insight sitting right here on the 200. It's not extended, and I like the pattern. A little bit of momentum comes in. This goes higher. Might be one that I'll be looking at. And for whatever reason, any stock that has the word oncology in it, and I'm an oncologist, a cancer doctor, has been on fire. But something like this, unless you know something, it's already extended. So I'd be careful. That's Cura Oncology. NVO is like the little brother to Lilly in that this one has two of the diet medicines, Ozempic and Wegovy. This company is selling so much drug that the Danish government separates its sales from the gross domestic product of the country because it's so much bigger. And their expectation is when those sales go away, you don't want to kill the financial outlook of the country, so they keep it separate. Is this a buying opportunity? It could be. It's just not giving me any of my setups. So let's take a look at my weekend review, which is a large list of about 2,000 stocks that made it through various technical cuts, and see if anything will come up to the top. So you're going to see a lot more stocks. It's a much bigger list. So these are the first two we looked at. BGC Group, I believe this is either a broker or an investment company. This is a group, think KKR, for example, that have been on fire. Nice uptrend. Here was the pullback opportunity, and notice you had volume, breakout momentum from a squeeze with relative strength, and OBV not yet picking up, but something to watch. It's breaking out here. That's a nice looking chart. Another nice one. This is where XLV didn't look great, but MedTech does look great. This is by Boston Scientific, a very reputable company. It's been around a long time. Volume, momentum, had a breakout signal the prior day. When the squeeze goes from yellow to green, it means you're coming out, and now you know the direction you're going. Expect a big move. Relative strength and OBV are good. This might be one of my favorite charts from looking. I don't know anything about Claris. It's below the 200. I'm going to pass. Then you got bonds. This thing pays about 4%, 4.25%. Paid a lot more down here because it's moved up 20% since then. Pullback, a little bit of a flag and a breakout here. I love the pattern. I'm just not usually trading a lot of bonds on these calls. The CBOE, big flag, and just broke out. Core, this is the old AmerisourceBergen. I know them well. I sold them two companies long time ago, so I don't know them that well today. But what a great uptrend. And whether you're looking at McKesson, Cardinal, or AmerisourceBergen, you're going to see similar great moves. I'll always call it Amerisource. It's now called Cencora. Why you would change your name when your ticker's ABC, I don't know. But still in a powerful move. These things do well in weak markets. That's probably why it had a strong day, up almost 1% when the market was weak. More bonds, we'll skip it. Another group that showed strength on this weekend's review were the MLPs. The MLPs go up if energy prices go up, and they're probably going to go higher. A lot of people are calling for energy to be one of their top groups in 2024. They also pay a nice dividend. I think this one's about 8%. So uptrend, nice move on Friday. I'm actually in one of them, and I've been in one for a while. I've been in ET. Why? Because it pays whoops, I didn't want that. It pays a big dividend. I guess they're giving me more data. Now, it doesn't look like anything short term. I keep this I think it's like an 8% dividend. But look at, when you can get a dividend in a market that keeps going higher from 9 to 13 since February 2022. It's been a nice backstop against things that weren't working in the portfolio. So there are things that look interesting. I don't know what happened here. I thought, was this the election in Argentina? Um, but boy, what a power move we had here. And it's funny, I looked at it on this day and I said, man, this thing's extended already. But sometimes in a powerful market, extended stocks can get even more extended. Another one I liked was Elevance. So I saw some interesting things in the managed care space. So you could look at Humana as one. This thing has pulled back a lot, so it's not going to make me that happy. United Healthcare, turning up. I think this one was probably one of the better looking charts. Molina Healthcare, yep, pulling right down into the 50. And I'll be looking for some momentum on this one. This one's been in a nice move as well. So typically what I'll do, and I'm not going to go through it much longer today, is I'll spend a lot of time looking at lists like this. Now, within wealth charts, they have something called sector scanner, and it is a way to build a watch list. So let's just build a watch list very quickly. So first thing I'm going to go in here, and I got to figure out what my default watch list is, and do I have one? I better make a new one. So let me go into add a watch list, and let's just call it New Year's. And okay, now let's go to sector scanner. Let's go. Default watch list is going to be New Year's. Apply. So what they've done here is they've given me the leading the sectors by daily, weekly, and monthly. And I find the algo score to be the best tool here. So if I go out weekly, the top three groups were financials, basic materials, and industrials on the algo. If I look at daily, I'm going to add technology and healthcare. Now I'm going to hit compare and notice that all the industry groups come up to the top here. So let's look at weekly algo score. And let's go down. I highlighted the top. I'm going to hit the shift key and I'm going to highlight here. Oh, I thought that would bring them all up. Let me try that again because I hit the wrong computer shift key. Oh, I got too many computers. Okay. Now I'm going to go over to daily. We do the same thing. Let's get everybody through. Just fill in the holes. So I've taken the top industry groups in daily and in weekly. All right. Now I'm going to hit compare. Now I'm going to rank by weekly algo. And I'm going to take it down to 750. Then I'm going to go to daily algo. And I'm going to take it down to 750. I guess I just have to fill them in. I could have just saved the weeklies and then automated this process, but that's all right. So I'm now building a watch list of the top performing stocks over the daily and weekly time period in the top industry groups. And now I'm going to add that to my watch list. Okay, now I'm going to go look at my watch list for New Year's and make sure it's populated. It's populated. So these are some of the top stocks in the market, and I want to look at them right now. So I'm going to go to my CAT scanner, and I'm going to rank them by dots, and I'm going to see what comes to the top. Change this to New Year's. Here it is. And these were the three that came up to the top. We already looked at Grifols. Big move up. Just to me, when I see this, I wonder if it continues or not. I'd want to know why. And we'll see if there were earnings on it that came out. Acco Brands, ACCO. Nice uptrend and a big move on volume Friday. And the third one that came up was BNS. Don't know anything. Bank of Nova Scotia breaking above the 200. Now, none of these look particularly attractive for various reasons. And I think that says a lot about the weekend review. After a couple of weekdays, I don't see as many exciting stocks as I see at other times. Again, all the results can be listed here. Wells Fargo, this is one of my other trading systems, the EMS. You see that arrow that came in here on a flag, and that might be something to watch as well. I just took out all the filters, and that's why all the stocks are showing here. Last thing I want to talk about is seasonality. And I want to talk about seasonality in respect to one stock. So give me a few minutes to move this thing around. We are going into 2023, so we'll say January 3rd, and we'll look at performance. That's 2-month performance. Look at 10 seasonal years. I'm a swing trader. Let's look at 8 weeks performance, the NASDAQ 100. And you could see over this period of time some of the leading performers. So we're in a seasonally strong period of the market. Over here on the right is a weekly chart, and I've used Keith Wade's premium indicator. So I'm just using the premium. But I could also, since I have it, as I bought it, I could look at adding additional lines as well. But right now, I believe we're just looking at the 10-year. This here will give you sort of a display when I pick a stock. So if you look at Tesla, for example, you could see the predicted type of a move over the next 2 months. So it's up 17.36% over the next 8 weeks. And if we look down here, it tells me it's been up 6 out of 10 times, average return 11.83, and you could see the positive weeks versus negative weeks. That one doesn't really look as good as some of the others. The one I wanted to pull out is one of my favorites at this time of year, and that's Netflix. And Netflix has great seasonality, 7 out of 10 years, average return of 10.41%, and I usually even bring it down more. In fact, if you look at, it didn't actually change the numbers very much, did it? Because it's looking at January 3rd to the 30th, 7.25% return, 7 out of 10 years. There have been some very big returns in Netflix. The last couple of years may have mitigated some of the big seasonality moves there, but typically Netflix runs into these earnings that we're getting coming up, which is usually the day after President's Day, and then blows out those earnings. Now, we could see 21 and 22 sort of killed the program. If I went back and I looked at 20 years, for example, not 20. Let's see if it'll give me 15 years. It's not going to change this, but over 15 years, Netflix has been up an average of 13.77%. Um, there was a time when I always took this trade. I think looking at what's happened in 21, 22, I think you have to be a little bit more cautious. I know that last year in December I did a trading event, and this was a big topic, and it had a very big move. But look for some strong seasonality, which is the point of this. Um, this quick little iteration. And one of the great things about wealth charts is it builds it in. It's not an additional cost. So let me put everything together. First of all, once again, Happy New Year's. Um, it's you know it was a surprisingly great year in the stock markets for people that do my type of investing in 2023. Surprisingly, because 2022 was a tough year. And second thing is the Wealth 365 event is coming up. I hope you look to this event as something that's a great opportunity and sign up. And then again, please help me out. Tell me how I can make these better. And again, I know I have sinus issues. You don't need to tell me to fix my sinuses. I get that at home every day. I have had them fixed. They didn't work. I've got to get them fixed again. You all have an awesome, 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 awesome holiday. We'll see you at Wealth 365. And thank you.